Hi, everybody. How are you? I'm Jenna Kim from the Gershman Group, and I want to thank you all for joining us again on our latest session dedicated to United Capital Advisors. As you know, we are speaking to many of your colleagues representing over 100 million in revenue of advisors such as yourselves, connecting you with attorneys, discussing platforms, and providing information so you can make those informed decisions. I know it feels like that countdown clock, just like in the beginning of this webinar, was ticking down, but you do still have options and time. The purpose of this session is to, one, go through your options, including staying at United Capital, to look and evaluate the competition and alternate firms, as well as your legal concerns. And with this ado, I'd like to introduce you to Roger Gershman.
Hello again, folks. Really appreciate you all being on at this late night, and understand this has been a very trying time for you all. And as Jenny said, we represent well in excess of 100 million of production nationwide, and we encourage you to talk with us, right? We're speaking to a lot of your colleagues, we're speaking a lot about acquirers, we're speaking to a lot of attorneys. We have tremendous experience in these affairs. And the basic message that we really want to portray tonight is that, one, you have time, and two, take advantage of this opportunity, which is a short period of your livelihood to decide where your career is going to go for the next 10, 20, or upwards of 30 years. Okay? So Peter Mallouk has massively miscalculated this acquisition. He's been a master acquirer of firms, 40 firms to date, $250 billion in assets. I mean, he's a true professional investor. As investors, as you all know, some deals are just destined to fail from the start. And he has seriously underestimated the impact of this particular acquisition, right? He overlooked the fact that advisors at United Capital are entrepreneurial, that they come from a lot of RIAs, and that the Goldman Sachs acquisition was a disaster from the beginning. Now he's backpedaling some, and the only solution that he's offering currently is join United Capital 2.0. There's been a tremendous amount of, or lack of transparency. Now, certainly there's a call tomorrow night with the heads of offices, and a lot more details will come. But we're here to talk about, what that option might be. And look, in all due respect, it could be your best option. So I'd like to talk about United Capital 2.0. I mean, recreating, keeping the band together is, is a neat concept. But there's so many questions and concerns. Who's going to run it? What kind of economy scale is needed to keep it profitable? What are the risks associated with it being eventually folded into creative planning? I mean, Peter's real main baby, of course, is creative planning. And when this fiasco is over, he's probably got about $100 billion of pipeline acquisitions ahead of him. So he's looking to, in all due respect, slam you into this concept. Now, certainly there's a lot of issues, concerns, such as the valuation, right? $850 million valuation is what he bought it for. And so he's offering equity in this NewCo of an average of, call it 30 to 50% of your T12, some convoluted economics that he's deriving. But at what valuation and terms, uncertain. Certainly 50% of, plus minus of your legacy accounts, 35% plus minus for your non-legacy accounts. And what's the legal contract going to look like? We're hearing it's almost identical. And most importantly, looking to close you by next week.
Roger, if I may interrupt real quickly.
Sure.
I'm sorry. The most important question that has been coming, most frequent question, because as you just said, that is closing next week. So what happens if they don't sign by next week?
So what he's suggesting is that you sign or resign. And want to let you all know that you all have the power to delay this transaction and actually the right to do so, and should to get yourselves all together in keeping conversations going with Peter and negotiating, even if you've decided to leave this firm, as he tried to kick the can down the road in the very beginning by offering this option. You all have the power to kick the can down the road as well. Do not accept that you need to make a decision by next week. You need to know what the mechanics of this are. You need to know about the valuation. You need to know about your contract. You need to know about your payouts. You need to talk to your attorney. There's lots and lots of excuses why you do not have why you shouldn't sign. This happened a number of months ago with First Republic. JP Morgan tried to slam them into, signing or resigning as well. And every advisor who had a sizable business just like you all have were given the ability to kick the can down the road, because Peter really wants this to work. He wants to negotiate. And look, and you all may have a great interest in negotiating as well. And this really could be your best option. But what the purpose also of this meeting is to talk about what your real value is in the marketplace, okay? And I want to just describe about comparing and contrasting big banks and brokerage firms to creative planning. Now, we're not here to suggest you all join a big bank and brokerage firm, but the platforms that these firms offer are magnitudes larger than what creative planning ever can offer, including United Capital and even Goldman Sachs. The Merrill Lynch's, UBS's, and Morgan Stanley's. I mean, huge platforms. Family office services, trust services, open architecture investment solutions, alternative investments, sophisticated lending, financial planning, technology, delivery, systems, operations, and huge support. What the value of your practice is these firms pay you as an employee 50% plus deferred, and sometimes upwards of 60% in total compensation. Peter's suggesting that if you join creative planning, we've got everything that these other firms have, but we're going to pay you 20%. What's the value of that? Or say with United Capital 2.0, we'll pay you 35. The value of your business is worth 300 to 400% of your T12. We all know the negatives, the 10-year contracts, the W-2, they're heavily regulated, but the purpose of this slide is just to tell you what your value is. Now, what about your value in the open market in the RIA space? What's the value of practice? And so one firm that people are speaking to is New Edge Wealth. Now, again, we're not here to solicit you to talk to these firms, but we just really, and many of you are actually speaking to New Edge, which is one of the fastest growing RIAs in the country with a $150 billion asset-based company, okay, that has very sophisticated, it's a very sophisticated RIA, family office, open architecture, and backed by Leanne Cooperman of Omega. The value of your practice, they will buy your practice today, assuming that they evaluate it, is 400% of your top line revenue. 200% of that is in cash, long-term capital gains. 200% is in partner equity value. And the Parthenon Capital is the private equity partner behind New Edge. Well, they happen to be the 800-pound gorilla in the RIA space and the most successful acquirer RIAs and seller of RIAs, average turn of 5 to 10x. In fact, Parthenon Capital is owned by 25% by Goldman Sachs. So 200% in cash, 200% in stock. What is that worth? And backed by, again, Leanne Cooperman, Jamie Dion, and Bob McCann, who ran UBS. I mean, that's value. So other platforms that are, winning the charge, which is what we also profess is to create your own destiny and start your own RIA. And firms that are in the business of supported independence is an incredible business and a very, very efficient business. And when a Sanctuary or a Kestra or some of these supported independent platforms, you're not working for them. They're working for you. They're pure service providers. Technology infrastructure, backbone, investment solutions, compliance, operations systems, legal. They do everything for you, including your real estate. So just like you had it at United Capital, true plug and play. The difference is you own 100% of your firm. A $3.5 million business, a $5 million business today, is worth an average earnings around 70%. And that's 1099 income. Those are your expenses. Those are after your taxes. A $5 million business, therefore, is generating what, $3.5 million or so of earnings? You slap a 6 to 8x multiple on that, okay? That's what your business is worth day one. And by the way, Sanctuary and many other VCs out there would love to take a position in your firm day one. You don't want to sell day one, that's fine. We don't advise it either because it's your cheapest valuation. But think forward about when you retire, if you want to take over other businesses. Now, Sanctuary also offers equity. A transition capital of 40 bips. And again, we urge you to speak to a firm like that. Next, winners in this duke out is Kestra. Now, Kestra just happens to be in the business a bit longer than Sanctuary. They've got a lot more capital, and they're experts, again, at back office administration technology and supported independence. They happen to offer a lot more transition support, 75 to 125 bips. That's very negotiable. Back end bonuses are also negotiable. Average earnings, again, are 60 to 70% plus. It's a very, very fine institution. Other firms that you advisors are speaking about, too, is Farther. Really neat boutique RIA. It's a digital family office backed by technology executives, but also experienced in managing RIA. It's really interesting. I mean, this firm is offering a 75% payout. Again, the first 500,000 of production is only 50. The next 500,000 is and above is 75%. That's pretty outrageous. That's your value. And plus, they're willing to give you equity, on average, plus minus 25% of your T12 for a firm that is burgeoning and booming. Negatives, of course, are, backed by a VC firm. Who knows who they sell to eventually? And can you all afford the risk associated with, being part of such a young firm that we don't know what it's going to be like in 2 or 3 years from today? I think we have.
Roger, I have a question. We have a question from the audience. What firm, of these firms, what firm feels that would value my practice the most?
It really depends on where you see yourself. If you want to own your own RIA, Kestra is the winner as far as how they support transition capital. Again, upwards of 100% or more. Sanctuary, a lot less, but a more efficient platform. New Edge Wealth, de facto, hands down, the most attractive offer for your business. So out of those three, those are, one is certainly New Edge, two is Kestra, 3 is Sanctuary. But we also advise, we're of course representing quite a lot of your interests here. But others who may already be in conversation with some of these firms, I encourage you, even if you're in talking with them already, speak with us as well. They all want they all want your business, right? They all want you to join. And we're here as a partner for you, but also a partner for them to help them close you, right? And they pay us a separate fee, so there's nothing taken away from you. But what's the advantage of letting us help you? We know how far we can push Kestra, for instance. We know how far we can push Sanctuary regarding their net operating margins. We know how far we can push New Edge. We know how far we can push all these firms.
So another question from the audience. Where do you see most advisors going towards of these options?
So far, it looks like Sanctuary is in the lead. A close second, though, is Kestra.
And why is
Close
that?
second.
What are you hearing as to why is that?
Well, because Sanctuary is open architecture, Custodian, Schwab Fidelity Pershing, and some, and since Kestra is only Fidelity, that's a non-starter for others. So that's the reason.
Okay. Another question, if I may. How many do you feel are staying versus leaving? Peter Mallouk is, is going out there and saying that most are staying. Is that true?
Unequivocally, no. The message that I'm receiving from countless advisors is that they don't believe a word he's saying. And he's suggesting that a vast majority have already signed. That's just not true. I mean, how do you sign to something that you have no idea what the mechanics are? And who would sign on to something that, again, we'll know a lot more tomorrow, but there's been very little transparency on how this operation is going to be run. So the last, again, sale of First Republic, about 65% of advisors left the firm, didn't buy what JP Morgan was selling. We estimate that a good 60 to upwards of 70% are going to leave.
Okay. Another question that came up just now. Do you think that the WASP program continues under United Capital 2.0? Do you think the other firms, and do the other firms participate, or will they participate?
Mallouk says it will, or he believes it will by January. The direct answer is it's not going to happen. Why? Mallouk has taken a lot of advisors from Fidelity. Fidelity is not very happy about that at all. On an institutional side, yes, I believe Mallouk will be able to continue that relationship. But on the retail side, no way, not happening. So I've spoken to quite a number of execs. I've even spoken to Fidelity, and it's not going to happen. Now, other firms, the answer is, they don't, right? Farther, would love to be part of Fidelity's program. Kestra and Sanctuary would love to, and they are negotiating today to be so. So there's a very good chance they will, but we don't want to mislead either.
You're popular today, Roger. I've got another question for you. What if I didn't sell my practice to United Capital? Can I immediately solicit these clients circumventing the Goldman Sachs restrictions?
So we're going to get into the legal questions, but that's a good one. So the answer is that's a very, very strong case legally that they don't own that piece of your business, and your ability to start your practice immediately is highly likely. But again, the firms that are acquiring you or taking you on, Kestra Sanctuary or otherwise, that's a decision between a negotiation and support by their legal counsel, your legal counsel, and a strategy that they will be very eager to support that effort.
Okay. Like I said, you're popular. Can I tier? Another question. Can I tier into my new firm, such as to have support staff start until I join, or stagger advisors so that I can and have some join after?
So, support staff, absolutely. So your support can leave today and start the new firm. They could, build operations, get everything set up for you. But what you can't do is stagger advisors. So if one advisor joins in 3 months and then another one stays behind to, help manage those accounts and then joins you later, that would be selling away and highly illegal. Though a strategy that even when I left years ago, when I moved from UBS to Credit Suisse, I identified an advisor, a friendly advisor within the firm that would handle my book while I'm away, and I directed clients to talk to be serviced by that particular advisor. So those are the two. That's an added strategy.
Okay, next question from the audience. What are the risks and rewards of honoring my legal contracts?
If you honor your contract, a conservative approach, which we generally advocate, you all have a huge advantage versus a Goldman Sachs advisor. A Goldman Sachs advisor who leaves the firm, one, they can't tell their clients are leaving the firm before they leave. Two, when they do leave, you got a boatload of Goldman Sachs advisors who are all over your accounts. Stay at Goldman Sachs because it's Goldman Sachs. Well, guess what? The average Goldman Sachs advisor who does have to honor their garden leave, and we've moved quite a lot of Goldman Sachs advisors in the past, move over 100% of their assets within 1 year. Clients are not clients of Goldman Sachs, they're clients of the advisor. And in many cases, in most cases, they have relationship for 5, 10, 15, 20, even 30 years. United Capital Advisors have a distinct advantage. Your clients are not there because of Goldman Sachs. They're there because of you. And when creative planning advisor happens to pick up the phone and tries to solicit your client, they don't know the brand. They're beholden to you. So,
Roger,
go ahead. Want to add?
go ahead.
Also,
No, I said that.
after 3 months, okay, announcements can be sent out. Your non-solicitation and can be, and your non-compete can be effectively managed by your acquiring firm as well as your attorney. And this is a short period of time in one's livelihood, 3 to 6 months of one's livelihood for the next 10, 20, 30 years. Is that worth it? Go ahead, sorry.
Not a problem, not a problem. The other half of that person's question was, well, what happens if I decide not to honor my contract? Then what?
So Texas did not, and we can learn a lot by Texas. And so there's a distinct advantage as well. First mover advantage. You have 3 to 5 days, maybe longer, maybe shorter, for the firm to slap a TRO on you. And so that's a lot of time to make that announcement and tell all your clients, and also have all your systems, operations set up. It allows your attorney to immediately start to negotiate the contract. Besides, the settlement will be within probably 3 to 6 months as well. What are the costs associated with it? Some advisors are, or some attorneys are throwing out some crazy numbers. Now, we know that Further is willing to pay the cost, and they're throwing out numbers like Market Counsel is, as well as Further, that it might cost $250,000 to even $1 million. If Further was willing to pay that much money for your practice, they would be out of business. Speaking to Raghi Dunn, speaking to Brian Neville, speaking to Sharon Ash and Tom Lewis, amongst others, the average costs, the attorney costs are literally can be as low as $5,000. They average around 25. Can they exceed $100,000? Yeah, they can, with a really protracted, brutal, process. But that's for one advisor leaving the firm, right? That's one advisor leaving Goldman Sachs. You guys are a group, and you have an economy of scale, and that these attorneys, right? You have economy of scale, bulk in numbers, and costs associated with it. So wouldn't be so afraid of those costs.
Another question. So with that, somebody just asked, if I am considering to leave, when would the least risky time to leave?
Least risky time to leave. Some advisors are thinking, well, why don't I just stick it out for, a couple months and then exit? We believe, as well as speaking to attorneys, that is one of the riskier strategies. Because once you're in, then it's hard to tell your clients, look, I'm with Creative Planning, or I'm with United Capital 2.0, but now I've decided to leave. And then that allows the firms to go even harder after your accounts and have remaining United Capital advisors even go after your accounts as well. It's not the most competitive advantage. Now is the time. So first mover advantage, the faster you move, the better. The faster you exit your garden leave, the better, whether or not you honor it or not.
Okay, one more question. You have mentioned in conversation, an advisor saying paying for legal or contributing towards that. How does that work, and how do I contact you?
So we work with all these firms, and we are offering to pay for your legal contractual cost associated with your move to a new platform. No, we're not willing to take your, TRO expenses and the like, but that's an advantage. But speak to us about your concerns with your attorney and your own individual strategy, right? Whether or not you should or not honor your garden leave. What's best for you, your family, your business, and your clients? And again, many are already engaged with, these firms, engaged with attorneys, but we have an outsider's perspective and look after your interests and your interests only to do what is best for your business. And that is you staying at United Capital. God bless, that's a really good decision after you've done your due diligence with United Capital, but other platforms as well.
So, Roger, to be respectful of everybody's time, since we're starting to run a little late, I just want to let everybody know In order to contact Roger, you can email him directly at roger@thegershmangroup.com. You can look us up on the website, thegershmangroup.com, and contact us that way as well. But in the meantime, Roger, do you have any closing words?
We're here for you, and we feel for you. This is really trying times. We've been through this many, many times with recently First Republic, Barclays, Deutsche Bank, Alex Brown, Hamilton Quist, Montgomery Securities, Lehman Brothers. We've been through this a lot. We think, we believe, we know you've been taken advantage of. We believe that your businesses are being tremendously undervalued. And to sit back and really take a breather and take it in and use as much resources as you possibly can to make the best educated decision for yourself, your business, and your clients. And again, talk with us, whether or not, again, you're speaking to other firms, maybe even the firm that you're speaking with, we didn't even address today. It's okay. We're not here to get you out of the firm. We're not here to say, okay, we're gonna, want to drive you to another firm. We're here for the best interest of yourself. And again, if that's staying at United Capital 2.0, God bless. We actually hope that's the best option for most of you. We just remain a skeptic and a pragmatic and a realist. And we look forward to taking in your questions, counseling you as best as we can, and pricing you at the best, highest possible price we can get for your business. Thank you so much for listening in again. And you can all reach me at 415-265-4029 or roger@thegershmangroup.com. Thank you so much.
Folks, thank you so much. All right, bye-bye now.